our special, the demonetization scare. We just told you the views of Samir Arora. We also caught up with Saurabh Mukherjea of Ambit Capital. He says the government's demonetization move is a lot of short-term pain, but plenty of long-term gain starting mid-2017. Let's listen in.
For the last year and a half, we've been highlighting the resets that we believe Prime Minister Modi would bring about. And when we first started talking about this point of view a year and a half ago, very few people paid attention. But I think subsequent events have borne us out. Prime Minister Modi clearly is bringing the changes which will result in short-term pain for long-term economic gain. A fundamental view has been that India will go through a set of structural changes which will result in the formalization of the economy, the reduction in black money, reduction in the black economy, big reductions in the cost of capital and reductions in the cost of land and real estate. That ultimately creates a more efficient economy for all of us to live and work in, a more efficient manufacturing sector, but it does entail short-term pain. We can't transition from an economy where 30–40% is in the informal sector into a country with lower cost of capital and lower cost of land effortlessly. And hence our point of view that you'll see some short-term pain, specifically in Q3, where the cash crunch will hit hard, but next year the picture starts recovering quite appreciably.
Which will be the earnings turning quarter then?
So Lata, depends on how you look at it. Relative to where consensus was, say, on 8th November, clearly this quarter consensus, and including us, it's not as if on 8th November we knew what was coming. Clearly this quarter consensus will be badly disappointed compared to what the expectations were on 8th November. I think as increasingly CEOs are starting to say, this could well be a quarter of degrowth for several companies. I think the companies themselves, to be fair to them, are being fairly candid that this is a quarter in which top line and bottom line could degrow for prominent companies. Compared to this, clearly Q4 will be better. Our reckoning is growth returns in Q4, albeit in sclerotic fashion, and then in the year to March 18, a degree of normality returns. Relative to the expectations that all of us had on 8th of November, I think even March 18 growth numbers will be subpar.
Have you done any rural checks over the last 10 days to understand how bad things are? Because the sense that we get from a lot of guys we talk to is that auto companies are expecting 25–30% fall in the month of November. Truckers are saying, things have come to a standstill. In your checks, how bad are things currently?
The near-term impact is clearly quite substantially, looking at top line hits for the quarter to December of anywhere between 10–30%, depending on who you talk to. But in a way, this quarter's hit is a bit of a sideshow. I know it feels very important and very sort of vivid for us because we're living through it. The big story, I think, starts from next year. From January, February, March, I think the big story starts as a whole host of SMEs who realize that they really can't function in a country where they have to pay full taxes. A whole host of SMEs will start, I think, winding up through next year and into 2018 as they realize they can't function in a country with full tax. And that's when the real drama begins, because that's when market share starts shifting to listed company market leaders. So whether it is in footwear, whether it's in sanitary ware or in electricals, we will start seeing market share migration, I suspect, from spring and summer next year, and that process will continue for a couple of years. It will lead to listed companies gaining market share, gaining earnings, but for that to happen, the unlisted, the informal sector specifically, will have to cede market share, and I suspect the informal sector will take quite a beating over the next 2 to 3 years.
Okay. So what is the earnings downgrade you are doing for FY17, and how are you changing FY18 earnings?
So FY17 on 8th November, I looked at our FY17 earnings estimates. On 8th November, we were roughly expecting something like 6–7% earnings growth for the Sensex in the year to March 17. My reckoning is now in the year to March 17, earnings growth will be more like 2–3%. So you've got a 400 basis points drop in our earnings growth expectations for the Sensex in the year to March 18. In the year to March 17, I'm sorry. In the year to March 18, we've penciled in 10% earnings growth. I have to confess that our expectation of 10% earnings growth in the year to March 18 at the moment is a little tenuous given how uncertain things are. If the Sensex delivers 10% earnings growth in the year to March 18, that will be the best earnings growth from the Sensex in the last, I think, 4 years. So it's been a while since we saw double-digit earnings growth in India. Each year the market begins with expectations of double-digit earnings growth, and each year the Sensex delivers sclerotic earnings growth. It could well be that the tide turns in the year to March 18.
Saurabh, two-part question. A, what's the feedback from investors? We have seen so much FII selling. all through the last 1 month, and that's only picked up. And B, how do you approach the market from portfolio point of view then?
So, as you would expect, right, both because of events at home, plus because of what Janet Yellen said last week in America, and also given Trump's whole point of view that he'll spend money, spend a lot of government money, US bond yields are running up. That's making investors jittery, because US bond yields running up is usually not a good story for emerging markets. So both because of events in India and events abroad, there is a fair bit of investor jitteriness. What I think accentuates the whole issue was going into 8th November, or going into November rather, valuations in India were looking very full. I think we wrote about this in October. I spoke about it on your channel, I remember, in early November, that valuations were looking very full. So I think the result of that is the market pullback that we have seen, and my reckoning is the market pullback will last a little while, certainly up to the Fed announcement in early December. I think the market jitteriness is likely to persist. But beyond that, I think there's a great deal of investor willingness to say, we understand that this is good for India, this is good for earnings, this is good for the country's longer term future, and in the context of India's longer term future, there is a great deal of investor willingness to buy sector leading franchises. As I said, whether it be in electricals, footwear, sanitary ware, kitchenware, FMCG, there's a great deal of investor willingness to say, give me market leading franchises, give me blocks in the same, and I'm willing to buy at the moment, I'm willing to buy through the pain. That's what I think gives us a great deal of confidence that India will see this through. India will see this through and come out stronger on the other side of this dislocation.
Okay, so don't buy markets, buy stocks is the overall advice from Saurabh. Finally,